Good evening, everyone. I'm your host, the economic analyst. The CPI came out for the month of February 2022 at 8:30 this morning. The month-over-month change was 0.8%. The year-over-year change was increased up to 7.9%. For the U.S., we saw increases in almost every single part of the consumer price index. Food was up by 1%. It's up by 8% year over year. Energy is up by 26%. It was up by 3.5% this month. And core inflation met expectations by rising 0.5%. But the major contributor that's weighing down this increase from reflecting more of the rest of the CPI is the shelter component, which is still being pushed down by relatively low rents of prices and owner's equivalent rent. I'll go into more of that detail in just a few minutes. One of the things that we're seeing is that with the fall in Omicron, we're seeing an increase in transportation prices once again, especially in airline fares. So that's being pushed up. I expect that medical care services will start to follow suit and start to increase. One of the things to note that's increasing the shelter component here, besides the rent of primary residence, is also more than likely a pickup in lodging or hotels. Year over year, as I said before, the inflation rate had reached 7.9%. Again, we're going to have to go all the way back to 1982 just to see inflation rates this high. And as many of you have pointed out, the CPI indices that were used to measure inflation back in the 70s and the early parts of 80s up to the end of 1982 used a few different metrics than what we are using now. And there has been many accusations toward the BLS that they are suppressing the real inflation rate. And indeed, there are alternative websites that try to capture what the real inflation rate is using the old ancient metrics. I myself have had a few ideas on how to capture that and have done my own analyses on that. And I'll be making a video on that once I find something definitive as a way to approximate that old CPI report. When we take a look at the consumer price index to final demand, we see that, for the large part, since we started tracking final demand prices for the past 12 years, that the CPI and the final demand ran right along in line very, very, very closely. There was a couple parts here where final demand ran ahead of the CPI, and we're beginning to see that manifest here, but then typically speaking, it would catch up. When we take a look at the year-over-year change, it becomes more pronounced. Final demand prices are up by nearly 10%, and probably February's numbers are going to show them above 10%. In the meanwhile, the CPI is 2% cooler than that at 7.9. The major contributing factor that I think here is the way that the modern consumer price index measures and accounts for the increase in housing expenses. So up until 1982, they actually used the housing price and the mortgage interest rates as the major factors to determining the housing component of the consumer price index. But starting in 1983, they started treating it more like rent and used owner's equivalent rent. So they would survey households that was actually renting out their prices and use that survey and applied it to the entire housing component industry here. And that's really where the major driver is, beyond some hedonic adjustments for substitutionary effects that started taking place in 1990 that caused accusations to say that the CPI was being suppressed and that it's not reflecting the real inflation rate. Adding to this, we can see that when we compare housing prices in red to the CPI shelter component in blue, the shelter component and the housing price index ran right alongside each other in the 1970s and early 1980s, but during the 2005, 6, and 7 housing bubble, that did not manifest. Instead, the shelter component stayed unusually subdued during this, and indeed we're seeing this kind of disparity now. But I do want to put out a cautionary note that another difference between the 2000s and now is that we had unusually low interest rates and falling mortgage rates at this time. This was at a time when mortgage rates were climbing because the Federal Reserve under the chairman, Paul Volcker, was drastically raising interest rates. And just for food for thought here, based off my own analysis that I have done, the disparity between the CPI of the modern methodology and the CPI that was used in 1982 and before, I worked it out to be on average off by about 0.9% per year. But I have to take note and caution here is that I had a very limited breadth of scope of years, basically only 5 years of data to compare the two indice metrics, and so it's not really going to give you an accurate reading assessment, especially during the times of housing bubbles or housing burst, on how would that reflect the disparity between the two CPIs. But based off my estimate, the ancient CPI would be reading about 0.9% higher on average on the year, and given these rising high prices, the number is probably greater than that. So if I were to guess what the real CPI is probably much closer to the final demand inflation rate. So in other words, as a guesstimate, we could probably use final demand inflation to gauge what the real CPI is, and this may account for some of that disparity between the new CPI and the old CPI, and why there's a difference between the new CPI and final demand. Now, something that has me concerned here is that real interest rates, this line graph here is the federal funds rate subtracting out the consumer price annual inflation rate. Real interest rates are now hugely negative, and they're more negative now than they ever were during the 1970s, which means that Paul Volcker will have to raise interest rates higher, Jerome Powell will have to raise interest rates higher now as chairman of the Fed than Paul Volcker had to do during the 1980s. And indeed, Paul Volcker, in order to contain price inflation and make those numbers come down quickly, he had to raise the federal funds rate higher than the inflation rate by a good 5 to 6%. Maybe it was almost 10% higher at one point. He raised interest rates to 20%, while the CPI annual inflation rate was approaching 15%. If Chairman Powell has to do the same thing in order to contain inflation quickly, then we could be looking at a federal funds rate of 10 to 15% in order to contain that inflation rate. But the truth of the matter is I don't think that Powell will do it. Certainly the measures that the Fed is taking is very, very slow. They're very, very hesitant to raise interest rates, and for this reason, I have deep concerns that we could be seeing a spiraling effect as inflation gets out of control and starts growing even larger here on out, because the Fed is basically losing track of the inflation rates and especially the real interest rates. And this could have severe consequences for the economy, especially if the Fed refuses to raise interest rates and contain that inflation rate. We could be seeing inflation get out of control, and it could, along with geopolitical situations that have developed with the sanctions on Russia, the war of Russia and Ukraine, and how high commodity prices are spiking as a result of those measures being taken, that could literally lead to the demise of the U.S. economy in the near future, unless drastic measures are taken by the Federal Reserve and the federal government. Last month, I predicted that the inflation rate would grow by about 1%. This is based off of my final demand model. We got 0.8%. The difference was about 0.2. That's not very surprising there. When the producer price indice report comes out, and I believe they're going to come out early next week, probably Tuesday, I'll update this final demand report, give you out another video on that, and start forecasting what I'm seeing for March's inflation rate, which I expect is going to be fairly high, because of all the situations that are developing geopolitically around the country. Speaking of, the annual inflation rate is looking like it's going to end this year at around 8.6% as we measure by the CPI. I'm tracking this by taking the average and the median and just extrapolating that out for the rest of the year. In truth, though, I suspect that this number is actually going to be higher because of the Ukrainian war situation that's been going on. The sanctions have not been factored into this. This is just showing a basic trend analysis from what's been transpiring over the past few months, and that could certainly accelerate the inflation numbers. So all attempts to really project out the inflation rate are really going to fall flat. But the way that I'm looking at the projection rate for the long term now is I'm really not looking for the inflation rate to calm down. Originally, I was going to have the inflation rate calm down to say around 5 to 4% as the years pressed on in the 2020s. It is now my fervent belief that based off the situations that's been developed and the possibility of an emerging Cold War is that we are going to have systemically high inflation for years as political gridlock and Federal Reserve hesitancy to raise interest rates to real rate levels is going to keep inflation elevated, combined with sanctions, shortages of goods, shortages of commodities, particularly in minerals, metals, wheat, and oil. Those are going to continue prices to be elevated on that ground. And therefore, I really don't expect to see inflation drop under 8% annually for any sustained period of time. Instead, we're probably going to coast around this 9 to 10% level right now in the inflation rate, especially considering that GDP, based off of GDP now by the Atlanta Fed, is showing a very dismal first quarter. The last update had GDP being hovering around 0%. They've now increased it to 0.5%. The survey of the top 10 and bottom 10 forecasting for economists shows the economy growing a little bit stronger than that, around close to 2%, but I don't think we're going to get that high. So in any case, this is showing that inflation is becoming entrenched and built in. The Fed is just hopelessly behind the curve. And in my opinion, politically speaking, it's not going to be feasible for the Fed to raise interest rates above that inflation level. Their best hope is to raise the interest rates a couple of points and hope and pray that this will cause some relatively easing on the annual inflation rates. But considering that the inflation rates now are so hopelessly negative and the geopolitical situation is not helping that, it's my fervent belief that we're going to see sustained, very high inflation rates, and that will eventually force up interest rates and could cause a situation where the Fed will lose control over those inflation rates. This is basically the worst case scenario, and I don't really see it manifesting any other way right now unless if the situation changes drastically geopolitically, because fiscally and monetarily I don't really see our politicians and officials making the right decisions to contain inflation. More than likely, they're going to continue some level of easy monetary policy and heavy fiscal spending and high deficits, and that's going to have severe consequences on the economy. Guys, thank you for watching this video. If you have any questions or comments about things that I said in my analysis, please let me know. Let me know what you think. Drop a comment down in the comment box. Am I right on the dot on this? Am I missing something? I would appreciate to hear your words and your thoughts on all of this. I am doing an analysis of the CPI methodology compared to the old ways that it did the methodology. I'm working through that, but I'm not ready to produce a video on that yet. When I am ready, I will create one and start walking you through hopefully a better way of approximating what our inflation rate is using the old CPI for those who are very skeptical of the current consumer price index. And I may, if I'm able to approximate that pretty well, I may even use that as an alternative index moving forward. If you like the channel, if you like the content that I produce, make sure you just show me some support. Like the channel, click that subscribe button. If you haven't already, click that notification bell. You'll be notified whenever I do upload a new video. Again, I may upload a video over this weekend talking about recent trends that I'm seeing develop in the markets. But if I don't, the next video will certainly be out early next week on the Producer Price Index, so we can get that consumer price forecast going on and giving us a little bit better line of sight of what's going on in March. Once again, I thank you for watching this video, and I'll talk to you next time.